All right, Arthur Bass. He's the managing director of fixed income over there at Wedbush Securities. Also doing financing and keeping an eye on interest rates here. Mr. Bass, how you doing today?
I'm doing great. I appreciate being on your show. Thank you for having me.
Okay. All right. Well, there's a lot of things going on in the market. And, sometimes, we focus on different things. But the big focus earlier in the week before we had the geopolitical news was Powell and interest rates here. And, they're not asking me. I didn't know, an interest rate cut with the market at all time highs, a half a point. Well, they do what they do. But your last note here in September, maybe another 50, maybe not. Give us your take here on the current interest rate environment.
Here's my take in a nutshell. Okay, markets don't know. I don't think the Fed knows. Probabilities for the November and December meetings, the next two meetings, have ranged from as low as 25% probability of a 50 basis point move to as high as a 60% probability. We're right now pricing as of, let me just look at my sheet. We're pricing roughly a 35% probability of a 50 in November and a 40% probability in December. My view is I think they're going to go 25 and 25. There's a school of thought that says, hey, the Fed should have done something in July, and the 50 may have been a catch up. I take my thoughts, one, from Powell's comments. He said in the press conference last week that nobody should take the fact that we moved 50 today as a sign that this is going to be our pace ongoing. And then he also stated in his comments he spoke 2 days ago. He said the risks are two-sided, and in the question and answer, he said this is not a committee that feels it needs to cut rates quickly. So I look at this that, okay, fine, we had the 50 basis point move. Right now, I think they're heading towards the 25. If you also look at the Fed dots, I don't know if you're familiar in the summary of economic projections, only one member projected a 25 and a 50 basis point move by the year end 24. I mean, they project rates for the year end 24, 25, 26, but there's only two more meetings in 2024. Only one member projected a 50 basis point move then. 9 projected two 25 basis point moves. 7 just one 25 basis point moves, and 2 projected no more moves. So, I mean, it's certainly a range of projections. The median is a 25 at each meeting. But the key, Joel, is the numbers are going to dictate it. I mean, we had the ADP number this morning was a little bit better than expected, but ADP has not been a good estimate of the employment number. Employment number is expected to be 145 to 150. But it's kind of interesting because last month they had that downward revision announced in the Bureau of Labor Statistics that they're going to revise down the employment number by 818,000 for the last 12 months, which will start taking effect next year. So everybody just divides that by 12 and they say, okay, fine, every number might be 68,000 higher than expected. So there's the market has a little bit of a
little bit of a bias. What about? I mean, you mentioned the ADP numbers. We have jobs number on Friday. We have some inflation data coming out, and of course, Powell said he's not on a preset course. Are they maybe on a preset course? And do you think the numbers that are coming out, those economic data points, which kind of had muted reaction in the markets, do you think the Fed is actually waiting to make the decision based on that data?
I think they're waiting to make their decision on two pieces of data. One, the employment numbers, okay, and we've had an uptick in the unemployment rate, primarily because the number of participants has increased, and you can take that from the immigration we've had, and that there are more people looking for work, not that there are less jobs. That's what caused the uptick in unemployment. But obviously, when unemployment upticked to
4.3 or something like that.
It ticked off the SOM rule. That if 3-month average of unemployment goes a half a point over the lowest level, then that's a predictor of a recession. And it's had a great track record. She herself kind of downplayed it because of the increase in the labor supply, but nevertheless, that's one indicator people are looking at for recession. The other is a negative yield curve, both of which have been very, very good predictors of recession. But so far, we haven't seen it in the economic numbers. I mean, the Atlanta Fed is now projecting 2.5%, revised down from 3 for third quarter GDP. Second quarter was 3%. 3% growth is good growth. I mean, that's not record high stocks, 3% growth. The Fed shouldn't be cutting aggressively if you look at that.
I agree.